countdown to the monetary policy announcement. Thank you for staying tuned. I'm Chimeze Obi Iwagu. The Central Bank Governor Godwin Emefiele will in a very short while announce the decisions of the Monetary Policy Committee. In the meantime, this is what the committee did at its last meeting in May. The committee voted to reduce the MPR from 13.50% to 12.50%, retain the CRR at 27.5%, retain the asymmetric corridor of plus 200 and minus 500 basis points around the MPR, and retain the liquidity ratio at 30%. Well, I still have with me the panel of discussants, Dr. Muda Yusuf, Director General of the Lagos Chamber of Commerce, still here with me in the studio. And of course, Mr. Tilewa Adebajo, the CEO, CFG Advisory, and Professor Waleke, who is a professor of capital market there in our Abuja studio. Well, I start off with you, Dr. Yusuf. Now, aside from the COVID-19 outbreak, macroeconomic data indicates that Nigeria, is heading towards recession. We've had the first quarter GDP showing a slowed growth. Inflation has been on the rise, currently at 12.50%. External reserves have been dwindling. Oil prices have slumped, hovering around $40. The PMI is declining. What do you think would be the key considerations for the committee members at this meeting, and how would that influence their decisions today?
Well, I think following from what happened at the last MPC meeting, the key consideration at a time like this is to stimulate the economy. I must admit that the central bank has been very bullish in the area of stimulating the economy, especially from the development finance angle. At least at the start, or at the start of this problem, this COVID problem, we saw the massive injection of liquidity, the consideration, the moratorium that was given to those who are who have a CBN facility, the forbearance that the banks were given, and all of that, and of course the SMEs and the health sector. So there has been quite a lot of intervention by the CBN, and the spirit of the moment demands that we need to continue to stimulate the economy, especially in the light of the looming economic recession. But more importantly is to create confidence. Because if you don't have confidence in the environment, it will be very difficult to stimulate investment. And I go back to the issue of FX. FX is very central to the investment environment. Because this economy is also heavily import dependent. We are not saying that we should have a policy that will continue to encourage import dependence. But you need clarity, you need certainty, you need confidence around the policy environment, around the macroeconomic environment, so that you don't have anxiety. You don't have a situation where people are just scampering to do anything just to get whatever they can get. So there is need for clarity around the foreign exchange market, and that is very critical to even accelerating whatever process you want to accelerate, to ensure that we properly stimulate investment in the economy.
All right, Mr. Adebajo, let me come to you. What sort of policy measure would you advocate for the MPC to have at this crisis time? Would you support a dovish or a hawkish stance?
Well, first of all, I think monetary policy has rendered itself ineffective in terms of creating any stimulus to grow the economy. And I think we're clear that we're going towards a recession. I think, as Dr. Muda has said earlier, the area of focus that the central bank has been very effective has been in the area of provision of concessionary finance for development finance, which has been very good, and I think very clear objective in their policies. But in terms of the standardized monetary policy instruments which they have at their disposal, I don't think any of that can work at the moment. So I think the focus of the central bank now should be to see how they can sustain and support the economic stabilization plan, which was recently launched by the vice president. I think all hands need to go on deck in that respect. The challenge, of course, that the central bank is facing, we've talked about foreign exchange, it's very clear. The other area is that of inflation. Inflation is a problem right now. Inflation is going up at about 1.5% a month. And if that continues at this rate, we're looking at inflation of 18 to 20% by year end. So that is really where they have the challenge. So the question is, as you've said from your earlier presentation from the beginning, all the African countries, or most of them, are cutting their interest rates by about 50% on average. We've only cut down interest rates by only 100 basis points. So the fact is that in the midst of an impending or a looming recession, is our central bank, because of inflation, going to go ahead and start to raise interest rates? I think this is the dilemma that this MPC meeting faces today. But outside that, I think it's very difficult for the central bank to do anything else, because monetary policy at this stage is no longer effective. And I think the effort should be going towards supporting the economic stabilization plan, especially with the effectiveness of creating liquidity and providing funds. If you talk to any bank today, they won't take money from you for more than 90 days. And if they take money from you for 90 days, no bank in Nigeria will give you a deposit of more than 4% if you're bringing over 100 or close to 500 million naira for a fixed deposit. That should tell you a lot. So that is where we are today in terms of the economy. So what we see with the central bank is that I want to see how they're going to resolve that dilemma of managing inflation when the economy is going into a recession. Are they going to hold rates? Are they going to increase rates to stem inflation? Or are they going to cut rates to be able to create more stimulus?
All right. Okay. I'm being told now that the central bank governor, Godwin Emefiele, is ready to brief the press.
Across the world. The projected global output contraction was revised downwards as many countries had to extend the lockdown period in the wake of a second wave of coronavirus infections and continued lack of effective treatment or vaccines for the novel coronavirus disease. However, there is cautious optimism that the global growth contraction would reverse to positive growth path by 2021 as the pandemic is contained, potential treatment found, and restrictions on business activities are lifted by most economies. The committee reviewed developments in the global and domestic economic environment in the first half of 2020 and evaluated the monetary policy options to address these challenges. 10 members of the committee were in attendance. The global economic developments. Global output growth weakened further as a result of the persistent headwinds from COVID-19 pandemic. These headwinds comprised persisting decline in global aggregate demand and supply, disruptions in global supply chain and trade, rising sovereign and corporate debts, heightened financial market vulnerabilities, low prices of crude oil and other commodities, and rising unemployment. The committee noted with concern the IMF's further downgrade of global economic contraction to minus 4.9% from minus 3% in 2020. The downward revision was based primarily on the amplified negative impact of COVID-19 pandemic on many advanced and emerging market economies as they witnessed extended lockdown periods and restrictions on economic activities. Committee noted the general optimism of a V-shaped global growth trajectory due to the expected early abatement of the pandemic and the gradual resumption of economic activities. However, the committee believes that global recovery, while assured for 2021, is more likely to be a U-shaped one. In this regard, it is not surprising that the recovery has been revised downwards from 5.8% to 5.4% in 2021. Committee observed the continued downward trend in inflation in most advanced economies, particularly below 2.0% long-run target, despite the huge monetary and fiscal stimulus injections during the period. Committee, however, noted that as the lockdown eases across the advanced economies, aggregate demand is expected to strengthen and inflation will pick up to support the expected output growth. Across the emerging markets and developing economies, the committee observed the divergent inflation trends, with most developing commodity exporting countries recording increase in inflation compared with other more diversified economies. This development had inadvertently exerted significant pressure on exchange rates of these economies as the pass-through to domestic prices has been amplified. The committee observed that the unprecedented increase in public spending to support households and businesses in the wake of the pandemic may spur inflationary pressure in some economies as the supply shortfalls struggle to meet up with the demand buildup. Domestic economic development. Available data from the National Bureau of Statistics showed that real gross domestic product (GDP) grew marginally by 1.87% in the first quarter of 2020, compared to 2.55% and 2.10% in the preceding and corresponding quarters of 2019. The performance was largely driven by 5.06% growth in the oil sector and 1.55% growth in the non-oil sector. The decline in output growth in the first quarter was largely attributed to the twin effects of the decline in oil prices and the shock from COVID-19 pandemic. Committee observed the gradual but persistent decline in the manufacturing and non-manufacturing purchasing managers' indices below the benchmark. The manufacturing PMI declined to 41.1 index points in June 2020 from 42.4 index points in May 2020. Conversely, though, the non-manufacturing PMI improved to 35.5 index points in June 2020 from 25.3 index points in May 2020. The trend in the manufacturing and non-manufacturing PMI was attributed largely to slower growth in production levels, new domestic orders, employment rate, raw material supply, and new export orders. Committee noted the staff forecast of 1.03% contraction in growth during the second quarter of 2020 on the back of the continued adverse impact of the pandemic on the economy. The committee expressed concern over the persistent, albeit marginal, uptick in inflation for the 10th consecutive month as headline year-on-year inflation rose to 12.56% in June 2020 from 12.40% in May 2020. The increase in headline inflation was largely driven by the increase in both food and core inflation, which rose marginally to 15.18% and 10.13% in June 2020 from 15.04% and 10.12% in May 2020, respectively. Committee noted the contribution of the legacy structural factors in the persistent uptick in inflationary pressure. These factors included disruptions to key supply channels due to security challenges from herder-farmer clashes, banditry and kidnapping, inadequate transportation outlay, epileptic power supply, and low technological adaptability. These factors have compounded the supply chain challenges. Committee reiterated the need for a robust fiscal policy strategy to attract private investment and capital to finance the huge infrastructure deficit in Nigeria and strengthen the existing initiatives by the federal government and the CBN in this direction. Committee recognized the supportive developmental roles of the CBN towards addressing some of these structural issues. The MPC specifically expressed optimism on the future impact of the 50 billion naira household and SME facility, out of which 49.195 billion naira 2,000 beneficiaries. The 100 billion naira healthcare and 1 trillion naira manufacturing and agricultural interventions to support the rebound in growth from the impacts of the pandemic on the economy. The committee further recommended the CBN coordinated COVID private sector intervention scheme, which had mobilized over 32 billion naira to support the economy, lives, and livelihood. Committee noted that the CBN had disbursed over 152.9 billion naira to the manufacturing sector to finance 61 manufacturing projects and another 93.6 billion naira to the healthcare sector, amongst many other sector-specific facilities. The committee is hopeful that upon further drawdown of these intervention facilities, the much-needed reset and rebound of the Nigerian economy will become a reality. The committee noted that broad money supply M3 grew by 1.64% in June 2020 from 2.72% in May 2020, largely due to increases in net domestic assets, NDA, and net foreign assets, NFA. The growth in M3, however, remained well below the indicative benchmark of 13.09% for June 2020. Aggregate domestic demand net grew by 5.16% in June 2020, compared with 7.47% in May 2020. The committee commended the CBN loan-to-deposit ratio initiative to address the credit conundrum, as the total gross credit increased by 3.33 trillion naira from 15.567 trillion as at May 2019 to 18.99 trillion naira at the end of June 2020. These credits were largely recorded in the manufacturing, consumer credit, general commerce, and information and communication, and agriculture, which are productive sectors of the Nigerian economy. Money market rates remained relatively stable in the review period, reflecting the prevailing liquidity situation in the banking system. The monthly weighted average interbank call and open buyback rates increased to 5.75 and 11.31% respectively in June 2020 from 5.22 and 5.80% respectively in May 2020. The committee welcomed the modest recovery recorded in the equities market as the all-share index and the market capitalization increased by 6.33 and 6.44% on April 30th and June 30th, 2020, respectively. The modest improvement reflected the resumption of business activities, which spurred market confidence as government commenced gradual ease of the lockdown. Committee noted the decrease in NPL's ratio to 6.4% at the end of June 2020 from 9.4% in the corresponding period of 2019 on account of increased recoveries, write-offs, and disposals. Committee expressed confidence in the stability of the banking system and urged the bank to monitor the compliance of deposit money banks to its prudential and regulatory measures to sustain the soundness and safety of the banking industry. In the light of the bank's continued efforts to find innovative ways of using local resources to diversify the sources of the country's foreign exchange reserves, the committee welcomed the decision of the Central Bank of Nigeria to develop a gold purchase framework under the federal government's Presidential Artisanal Gold Mining Development Initiative. The standardized gold bars, which will be purchased in Naira from Nigerian miners and refiners, would not only create thousands of jobs for the artisans, but to provide a new source of foreign exchange accretion to our reserves and ensure the strength and stability of our currency, the Naira. The committee also commended the federal government for the approval to establish a CBN-led infrastructure development company, which would leverage local and international funds for rebuilding of critical infrastructure across the country. This entity, which will be wholly focused on Nigeria and Nigerians alone, will be co-owned by the CBN, the African Finance Corporation, and the Nigerian Sovereign Wealth Investment Authority, but exclusively managed by an independent infrastructure fund manager that will mobilize local and foreign capital to support the federal government in building the transport infrastructure required to move agriculture and other products to processors, raw materials to factories, and finished goods to markets. The sum of 15 trillion naira is projected over 5 years for the initial run. The committee noted with satisfaction CBN's immediate work on the updates and timelines for the establishment of this much-needed entity. The outlook. The outlook for the global economy remains weak. The IMF's earlier expectations that the coronavirus pandemic will wane by the end of the second quarter of 2020 as economies implement the various prevention protocols were not achieved. Several countries witnessed a second outbreak after the initial ease in lockdowns. This necessitated the IMF's downgrade of output growth forecast for both 2020 and 2021. The slow recovery in oil prices and its attendant volatility is projected to continue in 2020 and well into 2021. This will further dampen recovery prospects, particularly for most oil exporting countries. With many central banks in the advanced economies exhausting their conventional monetary policy headroom, unconventional monetary policy tools will trigger global liquidity surfeit with consequences for many emerging markets and developing economies, including volatility in international financial systems and markets. Provisional data on key domestic macroeconomic variables indicate that the Nigerian economy may record negative quarterly GDP in the second quarter of 2020, but there is cautious optimism that the year may end in marginal negative territory with strong recovery prospects in 2021. The committee's consideration. The committee's considerations were guided by the developments in the global and domestic economic environment. The MPC noted that the current coordinated efforts by the federal government to contain the COVID-19 pandemic will reposition the economy on a sustainable path of rapid recovery. Committee welcomed the government's articulated fiscal stimulus to cushion the impact of the pandemic on the households and businesses through various palliatives and fiscal incentives, and reiterated the need for effective and timely implementation. The MPC expressed the utmost need for both the monetary and fiscal authorities to collaborate for the optimal synergy for measures targeted at reviving the economy. The committee called on the government to sustain its efforts at diversifying revenue sources and ensure fiscal prudence, particularly with the use of the recent grants and multilateral concessionary loans. The committee encouraged the adoption of counter-cyclical fiscal policy framework to shield the economy from persistent revenue shocks. The Monetary Policy Committee noted the bank's overarching commitment to maintaining price stability and encouraged the bank to sustain the current measures targeted at moderating inflation, including addressing some of the supply-side structural challenges. The committee urged the bank to continue to give particular attention to its mandate of exchange rate stability, given the recent volatility in the international financial system, to avoid excessive demand pressures in the foreign exchange market. The Monetary Policy Committee commended the bank on its efforts in sustaining the soundness and resilience of the financial system, particularly in the face of severe economic challenges. The committee noted the bank's drive to accelerate credit growth to the private sector, especially to micro, small, and medium-scale enterprises, and the recent monetary stimulus package to households and businesses affected by the pandemic. The committee's decision. The committee reviewed the policy options before it and argued that the option of tightening at this time will contradict the noble initiative of the expansion of affordable credit to the real sector, noting that this would heighten the cost of production, which will translate to higher prices of goods and services and harder economic conditions for our people. On the other hand, loosening monetary stance will provide the desired succor for stimulating output growth and rapid recovery, but with implications for domestic private investment and capital mobilization to support the huge domestic financing gap. Further cut in the monetary policy rate may not necessarily lead to a corresponding decrease in market interest rate, considering the current economic challenges. The committee was also mindful of the cut in policy rate at the last MPC meeting and the need to allow time for the transmission effect to permeate the economy. Given the plethora of monetary and fiscal measures recently deployed to address the impending economic crisis following the COVID-19 outbreak, it will be a relatively cautious option to hold in order to evaluate the effectiveness of these tools at addressing the current challenges, particularly with mounting uncertainties within the domestic economy, as well as the external vulnerabilities. After reviewing the three options, the Monetary Policy Committee noted that the imperative for monetary policy at the May 2020 meeting was to strike a balance between supporting the recovery of output growth and reducing unemployment while maintaining stable prices. Committee noted at this meeting that economic fundamentals have marginally improved by the end of June 2020, following the gradual pickup of economic activities as the positive impacts of the various interventions permeate into the economy. As a result, committee noted that the earlier downward adjustment of the monetary policy rate by 100 basis points to 12.5% to signal the loosening monetary policy stance is yielding positive impact as credit growth increased significantly in the economy. The committee also noted the positive impact of the various fiscal and monetary interventions on the household and SMEs and manufacturing sector. The committee also noted that increasing NPR at this stage will thus be counterintuitive and will result in upward pressure on market rates and cost of production. In view of the foregoing, the committee decided by a majority vote to retain the monetary policy rate at 12.5% and to hold all other parameters constant. The committee decided by a vote of 8 members to hold and 2 members voted to reduce NPR. All members voted to retain all other policy parameters. In summary, the MPC voted 1, to retain the NPR at 12.5%, 2, to retain the asymmetric corridor of plus 200 and minus 500 basis points around the NPR, 3, retain the CRR at 27.5%, and 4, retain the liquidity ratio at 30%. Thank you for your attention.
Thank you, Governor. Viewers, we have come to the question and answer session, but in consonance with the new normal, some of our pressmen have wired in some of their questions, and I have five questions from 3 pressmen here, and I will take those questions so that the governor can attempt to provide answers to them. I have 2 questions from Mr. Chima Obinna from This Day newspaper. The first question goes, there are fears that the COVID-19 pandemic has very adversely impacted banking systems across the world. How strong and sound is the Nigerian banking system today in the light of the massive economic and health challenges occasioned by the pandemic? The second question, he says, some of your critics have said that the forbearance you granted banks to restructure loans for their customers is like postponing the doomsday. What is your take on this? The second question comes from local change of the nation. 2 weeks ago, you started a currency adjustment. What should local and foreign investors expect from this exercise? Then Nancy Ilo Naji from AIT, Moneyline on AIT. You have made elaborate interventions to cushion the impact of COVID-19 on various sectors of the economy. Do you have any feedback as to the impact so far of these interventions? And lastly, last week, President Buhari launched the CBN gold buying project. How will this impact the way you manage Nigeria's external reserves? These are some of the questions coming from our colleagues. Mr. Governor, sir.
Well, thank you very much. On the first question, that tends to be asking questions about the soundness of the Nigerian banking system, let me say that, and repeat myself, that the Nigerian banking system remains very strong and resilient. I must say that unlike in other climes, the Nigerian banking industry appears to be one of the well-regulated industries in the world today. We have prudential ratios that have been prescribed for the banks, and they are required to ensure that they abide by those prudential ratios. For instance, some of the very prominent ones are the non-performing loans ratio, the capital adequacy ratio, or the liquidity ratio. To demonstrate the fact that the Nigerian economy remains strong and resilient, as at May 2019, non-performing loans ratio in the industry was 11.1%. As at June 2020, NPLs have dropped to 6.41%. For capital adequacy ratio, which is a ratio that measures the size of capital that banks deploy into risk assets, as at June 2019, capital adequacy ratio was 15.2%. But as at June 2020, it had just remained flat at 15%. On liquidity ratio, by August 2019, liquidity ratio was 48%. But as at June 2020, liquidity ratio had dropped to 37%. Yes, liquidity ratio has dropped, and I will say understandably so. Because, for instance, you will note that from around July 2019 to June 2020, gross loans and advances advanced into the economy as a result of CBN's loans deposit ratio has increased by 3.33 trillion naira from 15.6 trillion in June 2019 to 18.9 trillion naira as at June 2020. And these loans were granted to some of the productive sectors, like I read in the communique.
That was the Central Bank Governor, Mr. Godwin Emefiele, briefing on the decisions of the Monetary Policy Committee at their meetings today. And the committee resolved to retain the MPR at 12.5%, CRR at 27.5%, asymmetric corridor at plus 200 and minus 500 basis points around the MPR, and of course, liquidity ratio at 30%. Well, I still have with me my panel, Dr. Muda Yusuf, Director General, Lagos Chamber of Commerce and Industry, Mr. Tilewa Adebajo, the CEO, CFG Advisory, and of course, Professor Owaleke, who is a professor of capital markets. All right, let me get your reactions to that, Mr. Adebajo. Were you surprised at that outcome of that meeting?
Well, I wasn't surprised at the meeting. The surprise for me would have been if they increased rates. And I think he gave the explanation as to why he didn't increase the rates and why they didn't loosen rates, because they felt it will have inflationary impact. So I think invariably, I think they decided to maintain status quo. So at the end of the day, no surprise.
Dr. Yusuf, what outcome would you have considered desirable at this time? I know that for some time now, a lot of people have been clamoring for the reduction of the CRR, but that is not happening.
Well, from what we have seen, the impact of the reduction in MPR was very marginal, if at all. The CRR has a much greater impact on liquidity. Even though theoretically we have the CRR at 27.5, in practice, what some operators have said is that the effective CRR for some banks can be as high as 50%. So the CRR has a much bigger impact on liquidity in the banking system. It has a much bigger impact on the capacity of the banks to lend. So for me, I think the CRR is a much bigger factor when it comes to the instruments of, regulating liquidity within the financial system. So if you really want to ease the liquidity, of course, we have a dilemma here. We are talking about inflation, we are talking about exchange rate stability, and we're also talking about stimulating the economy. But we have to find a balance. Because if you really want to stimulate the economy, it is very difficult for you to avoid some level of inflationary pressure. Even in the literature, there's a relationship between growth and inflationary pressure. So there's a positive relationship, as it were. So if you really want to stimulate the economy, you don't really have to mind so much the fact that you have some measure of inflation. So if you really want to ease liquidity in the system, I think the way to go is to look at the CRR and give some more space to the operators in the financial system to be able to support the economy.
All right, Mr. Adebajo, let me get back to you. We listened to the central bank governor talking about some of the achievements on the banks. The MPL has reduced. How would you, contextualize the broad-based impact of COVID-19 outbreak on the financial services sector, particularly the banking sector?
Well, from the explanations he gave, I think with the forced lending, which the central bank has pushed on the bank with the CRR, I think he came up with the numbers. He says lending increased by 20%. And I think portfolios went from about 15 trillion to 18 trillion. So there was a 20% increase in lending by the banks from the policies in which they instituted this year. So I think all in all, I think the financial system is quite stable. There's no problem there. It's a question of, are we looking at the banks recapitalizing? Is that coming online maybe towards the end of the year or probably sometime for next year? So those are questions that are being looked at right now. But it's important that the banks play more of a critical role in the economic stabilization plan. And that exactly it is to create that liquidity. And I think that by putting the CRR at about 27%, I think is forcing pressure on the banks to look for risk assets to which they should book. So all in all, I think right now we're quite stable in terms of the way the financial system is. It's just putting the policies together. And I think at this stage, what is critical is the synchronization of monetary policy, fiscal policy, and the two other sides we don't look at is the trade and investment policy. These four policies now need to be operating in synchronization for us to see the desired impact. Not just monetary policy, not just fiscal policy, but we need to bring in the Ministry of Trade and Investment, and we need to take a look at our trade policy, and we take a look at our investment policy. And under the economic stabilization plan, these four pillars need to be properly synchronized for us to see significant progress.
All right, Dr. Yusuf, talked about synchronizing these policies. For you, as a business person, or you coordinate the organized private sector, have you seen such synergy between the fiscal, the monetary, and of course the trade policy?
We haven't seen much of that synergy. And most often, we hardly talk about even the trade policy. Because the trade policy has to do with things like tariff, things like the exclusion from the foreign exchange market, things like border closure, things like import bans, and so on and so forth. So it is important that we reckon with that aspect of policy as an important component of policy to stimulate investment. Because what we need to deal with now is how we can stimulate more investment in the economy. Already we have challenge with government expenditure because of the revenue situation. We have challenge with consumption spending because the economy is down. So what we need to focus on very critically is the stimulation of investment. And the way we manage the trade policy, the way we manage the regulatory environment, all these things are very critical, to support whatever efforts we are putting in place in the area of monetary policy or fiscal policy to ensure a faster recovery of the economy.
All right, let's still go back to what's happening in the banking sector because, of course, it's a critical sector for the economy. And recently, the central bank came up with a policy where it came up with a guideline, what called the Global Standard Instruction. This is just in a bid to reduce the MPL. And, where for you as an individual, if you owe a bank A, for instance, and then you're unable to pay your loan, then your account will be debited, and your account in Bank B will be debited. I mean, just wondering why it's just an individual account and the corporate account is not included in all of this.
Well, I imagine that perhaps the guideline for the corporate account is still in the works. That is my feeling. But talking about the issue of defaults in payment of loan, I think that is also very important. Because there are different categories of borrowers. There are some serial borrowers who also serially default in payment. They move from bank to bank. So if you have this kind of framework to checkmate that, I think it's not a bad idea. But what we need to be careful about doing is when you extend this kind of policy to the corporate organizations, we need to be careful so that we don't create a situation where we begin to criminalize business failure and things like that. Because as an investor, if we invest the money that you have borrowed, there is no absolute guarantee that the investment will work out well. There's no guarantee that you may fail and you may also succeed. So you don't have that room for businesses to know that, well, you are taking a risk. If the business fails, you should not be criminalized for business failure. That does not mean that you don't have to repay the loan. Of course, before you take a loan, there are contracts you sign between yourself and the bank. And the system should operate within the framework of the contractual agreement between the banks and their customers. I think that is what should stand.
All right, Mr. Adebajo, to what extent will the MPC decision complement the economic sustainability plan?
Well, I think it's, like I said, there's not much that can happen with the monetary policy anymore. And the only decision is that it's remained the same. And I think what the central bank needs to do now is to focus more on its quantitative easing, all the intervention funding it's providing to various sectors of the economy. I think that is where the central bank will be most effective. What the central bank also needs to do, as we've said earlier, is to provide a market-driven, non-static exchange rate market, foreign exchange market mechanism that is not only clear but transparent, that will help stimulate and boost that market. Those are the two things I think the central bank can really focus on right now. As with any other thing, like I said, it also involves the coordination of policy, trade policy, investment policy, fiscal policy, and monetary policy. Somebody has to be in the middle, maybe the vice president, to be able to drive this for us to get some recovery. Because we're at a very critical stage, and it's not just monetary policy that needs to work. There has to be work on those four key pillars to see what will happen. Ideally, I would have preferred interest rates to be in single digits and to be able to create that sort of easing, to be able to stimulate investment so that people can begin to do more work, borrowing at 9%. I believe that is viable because at a point in time when the Nigerian economy was growing at 8.5%, which was the highest point, to buttress Dr. Muda's point, when the economy was growing at 8.5%, the interest rate, the inflation, sorry, I beg your pardon, the inflation rate with 8.5% interest rate, economic growth, the inflation rate was at 11.5%. So yes, growth at 8.5%, inflation at 11.5% is not too bad. So I think right now we all need to buckle down, and government really needs to make sure that this whole recession is not as bad. If they can do the right thing, put the stimulus and the buffers in place, the recession will not be as bad as been projected.
All right, Dr. Yusuf, to what extent will this decision impact asset classes and perhaps investment inflow?
Well, first of all, let me address the fact that the central bank is now looking in the direction of infrastructure support. From what the central bank governor said in his speech, we can see that the central bank is driving the process of setting up an infrastructure fund of almost 15 trillion. I mean, that is quite significant because it is not enough to make funds available, to investors and all of that. We need to create the environment that makes these investors more competitive. And over the years, we have noticed that one of the most difficult challenges for investment is the challenge of the structural problems. Infrastructure provision, roads, power, and the rest. All these things have been affecting the capacity of businesses to be competitive. It has been affecting the capacity of the economy to become more diversified. So the fact that the central bank is now shifting attention to the area of infrastructure, I think, is something that is commendable. And the more we're able to diversify the economy, the more we are able to also make the economy more sustainable, the more we're able to withstand some of these shocks that comes from the external sector, oil price shocks, and the rest of them.
Okay. Now, how should investors respond to this situation?
Well, things are looking a bit clearer, if I may put the point that way. Of course, we have challenges around the forex market and issues of certainty and all of that around the foreign exchange market. But I believe that the central bank, with the current process of unification of the exchange rates, that will bring some confidence into the foreign exchange market, and that will help to lift the level of confidence in the economy. So, and with the easing of the lockdown, with the fact that economic activities are beginning to resume across the country, all of this will kind of stimulate more confidence among investors, and the economy will gradually begin to recover from the current shocks of the COVID-19.
All right, you heard the central bank talk about the gold bags that that was presented, that was last week, and that is supposed to be purchased in Naira. But wondering, gold is sold in dollars, so what's the Naira there?
Well, the good thing about that, first, it provides a very easy off-take window for the artisanal miners. Before now, we see the artisanal miners as illegal miners and all of that. So we are beginning to see a situation where they are now being better structured and being better recognized. I think that is one good thing about it. And given the stability of the value of gold as a store of value, that again, I think, will support the CBN's initiative to stabilize its reserves. That is the point that the CBN governor was trying to make. Because across the country, we see a lot of countries that have reserves in gold. And gold, over time, is one of the most stable sources of the store of value for an economy.
All right, let's cross over now to our Abuja studio, where Professor Owaleke, of course, is standing by to make his input. Professor Owaleke, I'm sure you listened to the central bank governor speak. What do you make of the entire decision of the committee?
Okay, well, Chimeze, as a result of, I'm sure, maybe technical challenge, I couldn't follow the speech. But I understand the rates are being held. All the policy parameters, are left unchanged. That didn't surprise me. I had, of course, predicted it. And that's principally because the central bank, as it were, has little room to cut rates, at this time. Even if the CBN is going to advance monetary stimulus or advance any form of stimulus, it's not going to come via the monetary tools, which in my view are already overstretched. The inflation rate at 12.56% and MPR at 12.5 already leaves a real return in the negative territory. So a further cut in the MPR will have dragged it further into the negative territory, and that has very grave implications for capital inflows into the country. Remember too that any investor who is doing any investment is not just particular about the return, but it is a return that is adjusted on a risk basis, including inflation. So inflation is always taken into cognizance. So I didn't see the MPC reducing the MPR, but of course. Again, if you also remember, Chimeze, in your background report, you had cited some countries in Africa. You cited South Africa. South Africa cutting rates to 3.75%. And that's because inflation rate in South Africa has moderated to as low as 2.1% as of June. Ditto for Ghana, that is also having single-digit inflation rate at 7.5. Ghana cut MPR to 14.5%. So what you find is that in countries where rates are being cut, they're also having an eye on the inflation threshold or inflation band. In South Africa, for example, that threshold is 3 to 6%. In India, is the same story, where the threshold is 2 to 4%. So, but I would have loved to see a situation where more liquidity is also going into the banking system through, for example, the cash reserve requirement that, in my view, is as high as is still high at 27.5%. So if the CBN, the MPC, had dropped the cash reserve requirement a bit, to make liquidity available to the banking sector, and at the same time, possibly to widen the asymmetric corridor. The asymmetric corridor, in my view, too, is also one that still incentivizes banks to park money at the central bank. So instead of having plus 200 basis and minus 500 basis, the asymmetric corridor could be widened to plus 2 minus 7. What that means is that the standing deposit facility now becomes 5.5% as opposed to 7.5%. So that is again an incentive, if you like, for banks to keep more of this liquidity and unlend them to the real sector as opposed to bringing them to the central bank. So I would have loved a situation where asymmetric corridor is widened and its CRR reduced. It's important that the central bank continues to also do something about the current risk aversion that the banking sector is experiencing. For understandable reasons, COVID-19 is making banks loan shy, and one way the CBN has also addressed that is this in the global standing instruction, which in my view will go a long way to also boost confidence and encourage the banks to lend, because what that means is that the banks are now having more comfort, more confidence that if they lend out money, the loans will come back. So non-performing loans in that process, become reduced. So
okay, Professor Waleke,
these are some of the things I would have loved the MPC to do. But by and large, it's important I say this, that the central bank should continue to scale up the development finance function because monetary policy tools appear overstretched, in my view, in tackling the issue of growth. Growth is fiscal. Let the fiscal, again, Chimeze, let me say this. There are also fiscal surprises. The central bank should also have an eye on the fiscal surprises. The budget is 10.8 trillion. The central bank never foresaw that the budget was going to be increased to 10.8 trillion. So with 10.8 trillion, with all the interventions coming in, liquidity will be in the system. So there will be fiscal surprises that the central bank should also stand ready to manage. Remember, too, that the cash reserve requirement is unremunerated. So it's more like a tax to the banking system, which is also why we are saying is in the interest of the banking sector if that is reduced.
Okay, Professor Waleke, a quick one before we close this show. Yes, the central bank governor is saying that, okay, they are looking at, they thought or hoped for a V-shaped recovery, but perhaps what they're going to see is a kind of a U-shaped recovery. For you, what sort of recovery are we likely to see? A U a V or a W?
No, I agree. It's going to be a V-shaped this year. The U-shaped he talked about is with respect to next year, 2011. The V-shaped, yes, this year. Again, I don't think that the economy will shrink, by as much as the IMF has, predicted. 5.4%. I don't think so, because if you notice what has been happening, again, I just give an example. In the first quarter, or rather, if you look at what was shared, at FAC for June, by February March this year, the prediction was that by June, what was FAC wouldn't be sharing anything more than 400 billion. That was the prediction. But what was shared last month was 650 billion. So what that tells you is that as we restart the economy, I expect to see an increased tempo in economic activities. Okay. If you also look at that June figure, companies' income tax, VAT increased, companies' income tax increased, custom duties increased. Okay, all these increased because of increased level of consumption. So VAT is increasing because of increased level of consumption. So I don't see the economy shrinking by as much with all the stimulus packages that are coming in. So it's a V-shaped. Okay. Even if we have a recession in the fourth quarter, I see the economy coming out of it very quickly. So, but for 2021, of course, it is going to be a gradual growth trajectory.
All right. Thank you very much, gentlemen, for your thoughts here. Professor Uche Owaleke, a professor of capital markets at Nasarawa State University, and of course, Dr. Muda Yusuf, who is the Director General, Lagos Chamber of Commerce and Industry, and Mr. Tilewa Adebajo, the CEO, CFG Advisory. Thank you very much, gentlemen, for your time today. And that's a wrap on the program. Thank you for watching. I'm Chimeze Obi Iwagu.